Hey Samsung, this is Shreya from Samaya. We are going to discuss about SA 450, evaluation of misstatements identified during audit. As always, we'll go and see the objectives of the auditor here. First, the objective is the effect of identified misstatements on the audit. You see, all the misstatements that were identified and assessed all the misstatements under SA 315. Now, what he has to do, he has to evaluate those identified misstatements. So what he has to evaluate the effect of that identified mistake and the effect of uncorrected misstatements, if any, on the financial statements. He, he has to evaluate the identified misstatements and the uncorrected misstatements, financial statements. The auditor shall also determine whether the overall audit strategy and audit plan needs to be revised. If whenever we identify any kind of material and identify any kind of material misstatements or what we have to do, as such information was got by the auditor during the audit, what he has to do is he has to change accordingly the overall strategy and overall and the audit plan, detailed audit plan, which was made prior to the starting of the audit at initial stage of audit, and revise the materiality also, and then do perform the relevant audit procedures that was with respect to the revised overall audit strategy and detailed audit plan. The author shall determine whether they have to be revised or not if the nature of the identified statements and the circumstances of their occurrence indicate that other misstatement may exist that could be material. You see, what we have identified misstatements and circumstances which indicate other misstatements. So we have to revise the overall audit strategy and audit plan, and aggregate of those misstatements could accumulate together would be material. And prior to evaluating the effect of uncorrected misstatements, like here, this is the second objective, right? Evaluating effect of uncorrected misstatement, he has to reassess the materiality that was defined. And with that said, we'll dive into SA 450 here. The misstatements may result from: what is the reason for the misstatement? Inaccuracy in the data in which financial statements were prepared, omission of any amount of disclosure, or incorrect accounting statement from overlooking or clear misinterpretation of facts, and judgments of management concerning the accounting estimates were unreasonable. See, misstatements were happening in financial statements. What do financial statement contains? It contains some financial items with regards to them, journal entries and assets, liabilities, all the transactions and accounting estimates, and disclosures and notes to account. You see, all the data here was inaccurate. The financial statements used the data which was inaccurate. That's one thing. And omission of any kind of amount or disclosures. The second thing, this is with regards to the data. Inaccurate data, omission of data or disclosure. Second thing is accounting estimate. The accounting estimate was incorrect from overlooking or misinterpretation of facts. Anything, the reason, but the accounting estimate that was in the financial statement was incorrect. Inaccurate data, incorrect accounting estimate, omission of any amount or disclosure, and the judgments of management with regards to those accounting estimates were unreasonable. These were the four methods, like two with regards to accounting estimates and two with regards to data or amount that was disclosures in the financial statement. And clearly tribal. There was a small gap, a small difference between the clearly tribal and performance materiality. We often don't read as often as we read the performance materiality. So pay some more attention here. We'll discuss what is clearly tribal is. Matters that are clearly tribal will be smaller of magnitude than materiality. Even performance materiality is also of smaller magnitude. That's a smaller amount than of materiality. But what's the main difference? It's come here. Will be the matters that are clearly inconsequential, whether they have taken individually or in aggregate, whether judged by any criteria or size or nature. You see, they were no, they don't have significant amount, even they were aggregated together, but when they were aggregated they were material, that there comes the performance materiality, that one. So these all the matters which are clearly travel. Performance materiality is a materiality amount that was smaller in magnitude, that should also be, if any matter that crosses this performance materiality have to be taken into account, because while aggregated those could lead to a material misstatement. But clearly tribal were those material matters which, even though they were aggregated, those deviations do not lead to a material misstatement. And when there's any uncertainty about the clearly travel, the matter is considered not to be clearly travel. So what they are saying is there should not be any doubt with regards to the clearly travel. If you have any doubt with whether it's a clearly travel or not, do not consider it to be a clearly travel. Where clearly travel is something, is a safer zone. Factual misstatements, judgmental misstatement, projected misstatement. We'll see all the three ones. Factual misstatements were those misstatements, no doubt they were misstatements only. Okay. In fact, they were misstatements. That is, judgmental misstatements were those misstatements where there's a disagreement between the management judgments that it's a misstatement or not, and auditor is not agreeing with that, whether it's a misstatement or not. There's a difference between those misstatements. That is, one party is saying it as a misstatement, and another party is seeing it as a non misstatement, not material misstatement. Those were judgmental misstatements. Differences arising from the judgments of the management concerning accounting estimate that the auditor considers unreasonable. You see, there was a difference between the management judgments and the auditor judgment with regards to accounting estimate. Projected misstatements are the auditor's best estimate of misstatements in populations. Projected misstatements were, the auditor is estimating that these misstatements could happen in a population while doing samples, with the while working on the samples that were drawn from the population. If he had got some one misstatement for the 20% of sample he had done, he is estimating that, he's projecting that the whole population consists of 5, that is 1 into 20. If one misstatement for 20%, then for 100%, 5 misstatements. So he's projecting that misstatement. These is the difference between factual, judgmental, and projected misstatements. Now we have come to our last part here, effect of uncorrected misstatements. What we have, our objective is the effect of uncorrected misstatements. For all the uncorrected misstatements, what the auditor has to do, what he has to evaluate. Prior to the auditor's evaluation of the effect of uncorrected misstatement, it may be necessary to revise the materiality. That's what even we have seen here. Prior to evaluating the effect of uncorrected misstatement, the auditor shall reassess materiality. That's one thing. With respect to the uncorrected misstatements, the auditor shall determine whether uncorrected misstatements are material individually or not, individually aggregate or not. Whenever there were uncorrected misstatements, he has to check whether they were material or not. Whenever you see, whenever we find any misstatements, we want to check whether they were material or not. If they were material, further audit procedures and giving a qualified opinion and checking whether there could occur a fraud or not, could do for the further improvisation of the misstatement. That's a thing that the auditor could do. And the auditor shall consider the size and nature of the misstatement for the class of transaction or account balances or disclosures and financial statements as a whole, effect of uncorrected misstatements related to prior periods. You see, now he has to consider the misstatement which was related, which could affect the prior periods also. What he has to done, first he has to revise the materiality. Second thing, he has to check whether they were material or not. First he have to revise materiality, check whether material or not. Third one is have to check the prior period also, whether they could affect the prior period also. Then auditor shall communicate with TCWG and their effect. Here comes communication part. If the effect of the uncorrected misstatement is immaterial, here what he is checking whether they were material or not, right? Now if he found that they were immaterial, they shall request the written representation from management. If management refuses to adjust financial information. That is what they were. That is why they were called as uncorrected misstatement. The management is not at all adjusting in the financial statements. Why only management has to adjust the uncorrected misstatements? Because preparation of financial statement is the responsibility of the management. If the management is only refusing to adjust the financial statement and auditor is not able to conclude whether the aggregate of uncorrected misstatement is not material, auditor shall express a qualified and adverse opinion. See, there were two nots here. You have to cancel and read it simply. The auditor is concluded that the uncorrected misstatements are material. If they are material, what he has to do? He has to qualify the report. First, what he has to do? Revise materiality and check whether the material or not, and check the effect on the prior period. If he thinks it was immaterial, ask for written representation. If not, shall communicate with the TCWG the uncorrected misstatement. The management, if refuses, he has to qualify the report. And that's it. We have completed our essay 450.